So I'm Brendan Dyson. My firm is Dyson Capital Advisors in Greenwich, Connecticut. I did my first shipping deal while at Lazard in 2011 for Euronav with Aaron Williams. Aaron and I still partner in maritime. And as Mike said, we recently did 2 shipping deals together for Scorpio Tankers and Diana Shipping. Both won Marine Money Deal of the Year awards. Today I have some very exciting ideas to share with you on creating value from volatility. But I have to warn you about something before I begin. I'm going to tell you many things from this podium that are absolutely false. But be assured that everything I tell you will be the truth, false and true at the same time. F. Scott Fitzgerald said that the test of a first-rate intelligence is the ability to hold 2 opposed ideas in the mind at the same time. He said it was a test of a first-rate intelligence. Now, I want all of you to know, as a courtesy before I start, that if any of you think you are going to flunk this test, you don't need to stay and listen. I see many of you have left. You can sneak out now or even while I'm speaking, and we're all friends here. Nobody will think any less of you. So the topic here is creating value from volatility. Volatility is free, valuable, and you have lots of it. You can sell your volatility for money. There are a lot of financial products that do that. You don't need me. That's not what I do. What I do is try and create value for companies using volatility, very different from just selling it. And to create value for a company in the current state of the markets, you need to accept innovation. I think it's helpful to understand that all financial innovation is just repackaging old ideas or shifting risk. And the reason you need innovation to create value for the company is that value has been repackaged largely for the investor's benefit. Your volatility, their benefit. And the risk has been shifted to you. CBs are the most common way for companies to sell volatility. And what I'm going to tell you now is that what you know about CBs is true. You know that CBs are not really a great financing vehicle, especially in shipping. That is true, and that is false. CBs are an incredible financing vehicle. What is true that CBs repackage your volatility for the investor and shift the risk to you. You get a low coupon. That's the money you get for selling your volatility. Convertible bond. I'm sorry. That's not value. CBs don't create enough value for many companies. Now I'm going to pause. I was told CBs are the word. I've used convertible my whole life. I love CBs. Is CBs a strange expression? I'll switch back to convertibles. So CBs don't create enough value for many companies to make them attractive. And the money you get ain't so great either at the end of the day. The ex-post cost of capital of conventional convertibles is very high. It can take your breath away. That has choked off convertible new issues to the market, and that is not good for investors. In the 1980s, it was different. The very best companies aspired to issue convertible debt. Every time an industry sector got hot, the really cool companies tapped the convertible market because convertibles were cool back then. Back then, even I was cool. I did convertible arbitrage. Back then, an issuer sold a slice of volatility up here, and once the share price went up 25%, the investors got the next 50%. And for selling that slice, the company got valuable options back from the investors. options to convert as soon as the stock hit the 50% trigger, options to not repay the principal for 25 years. That was the standard convertible in the 1980s. How many shipping cycles is that? Options to prepay anytime after 3 years. Great growth capital. Nothing ever went wrong for a company. Now, conventional convertibles have lost their cool. Why? Because the price of all these options can be calculated in models. The value to you as the company cannot. So Wall Street focused on stripping out the options for you, the company, to make the pricing more attractive in pitch books and in bake-offs. But that stripped out all the value for you, the issuer. My message to convertible investors is simple. I've been telling them for 20 years that they would see 10 times as many convertibles being issued if convertibles created value for the company. And they would make a better return than they do today. As an example, look at you guys. Are you in a hot sector? Yes. Are you cool companies? Yes. But no shipping CVs. Because you can't do the cool ones anymore. That is true and absolutely false. Here are a couple examples of using volatility to create value. Scorpio Tankers, 2020 down cycle. A conventional convertible refinancing would have doubled the dilutive conversion shares to buy more time until the shipping cycle turned up. That is true, but we made it false. How? Scorpio Tankers had volatility and the first-rate intelligence to hire my firm. We went to investors and said, hey, we need more time for the cycle to turn up. And we won't give you any more of our shares to do this deal in a down cycle. Anyone here know Robert Bugbee? No shares. And we told investors, we also want an option back from you. The option to convert you out once you have made 25%. So you get the slice from the stock going up 100% to just another 25%. And then we call it back and force conversion. Stupid idea, nobody would do it. To make it false, we added a contingency. We said, well, if you don't make this 25% from our volatility, which is free, we'll give you the 25% anyways, in cash, but only at the maturity date if the Scorpio stock doesn't go up. Well, you know what happened? Scorpio stock went up. They exercised their option to convert. Free volatility and innovation made it work. If you give investors a little volatility, they go crazy with excitement, and they will do incredible things for you. Cheniere, this was pre-completion of the first train to export LNG. High risk, high volatility. We issued an even better convertible than the cool convertibles issued in the 80s. For Cheniere, we sold a slice of volatility, not here, way up here, 75% conversion premium, no derivatives. The investors got just the next 30%. And Cheniere got options back too. Option not to repay the principal for 30 years. Option to repay the principal if they wanted to anytime after 5 years. And option to convert anytime the stock went up above that 30% slice. Valuable options. A very, very cool convertible. Innovation is risky, but you can easily de-risk innovation by marketing confidential without a public announcement. The marketing process with investors is under NDA. No shorting allowed. Investors cannot even speak to each other. It de-risks innovation. The market would eat you alive if you did this innovative stuff publicly, but we sell them in one-to-one discussions with select investors, priced and signed before any public announcement. But my last 50 innovative deals, 49 got done. The one that didn't, we had the book, but the shares traded down during the marketing process. Today, we're excited by the innovative type of CB, the repackaging of old ideas we did for Cheniere. We call it a high premium convertible. It's a better and cheaper convertible than today's conventional convertibles. Simpler, you get 50 to 100% conversion premiums without derivatives. It's more flexible because it includes the options for the issuer. And it's cheaper because it converts into fewer shares at every point of your share price performance compass. It creates value for companies. Another new innovation we have in process we call the high yield convertible. A little repackaging of a high yield bond. With interest rates up, coupon rates are up. We can make the high yield coupon go down by putting in a little slice of volatility way up here. If you put a conversion rate up 60 that ends up 90, you can cut your cash cost in half. Very excited about that. So what else can you do today? This is actually the real topic for today that we were invited to speak about. We have developed what I think is the coolest financing strategy ever. This is true. This is true. It lets you raise equity capital without diluting your shareholders or going to the market to sell stock. Marine Money awarded us the Innovation Deal of the Year for the dividend warrant we did for Diana Shipping. Been a very successful transaction. The drivers for this strategy are fairly common, even in this hot shipping sector. You want to raise equity, but the share price is too low. So you are not going to sell stock in the market because you don't want to hurt your shareholders. Some of you will. Some of you just did, but you don't want to. A little simple repackaging of old ideas that work. Pro-rata dividend to your shareholders. The dividend is a warrant, so your shareholders can buy your stock. The warrant is listed, so your shareholders can sell the dividend for cash if they want the cash. There's no dilution because it is distributed to your shareholders. To trigger the funding, it expires as soon as it's in the money. You get the cash, your shareholders get the stock, and your shareholders are happy. Hurt or happy? It's your choice. We think of it as a return of capital formation strategy. The outcomes are you raise equity you wouldn't have otherwise raised because you weren't going to go to the market, or you don't. And either way, your shareholders got a valuable dividend. You may think this is a trick. Too good to be true. It's not a trick. It's just repackaging. So let me ask you all a question. If I placed an ingot of steel gently on the surface of the ocean, would it float? No. If I welded thousands of ingots of steel together, would that make it float? No. Okay. Could you make a living going around telling people that you own a lot of really big piles of welded steel ingots that you say floats on the ocean? And you say these ingots can transport their containers, their grain, their oil, their LNG all over the world safely and efficiently? No? Yes. If you repackage the ingots into ships, because ships float. This dividend strategy floats. And it is a safe and effective it's as safe and efficient as your ships. There are always risks to everything. One risk is your share price goes down on announcement. But there are no technical or trading market reason for the stock to go down. I was an ARB. I know these things. I've done a lot of work on this. Stocks go up and down all the time. But it's not because you rewarded your shareholders with a dividend. And we now have empirical data. We've announced 5 dividend transactions. All 5 stocks went up after announcement. Luck? Sure. But they didn't go down. What's the other risk? It doesn't fund. Am I on the right page? Yeah. It doesn't fund. But you already said you're not going to go sell stock in the market. You don't want to hurt your shareholders. Nothing's different. No new risk, just a new opportunity to sell stock. Oh, and all our prior deals have funded. I think this strategy could become as commonplace as a shelf filing or an ATM because it's better. It's a better way to finance and raise equity. Okay, let me summarize all our opposing ideas. Steel ingots do not float. Steel ingots float, and you can make a nice living from floating steel ingots. CBs are not cool. CBs are very cool. Innovation is risky. Innovation is de-risked. To raise equity, you have to sell stock in the market and dilute your shareholders. To raise equity, you don't have to sell stock in the market, and you don't have to dilute your shareholders. All are true, and all are false at the same time. There's one factor under your control that will determine if the true or false ideas apply to you. It's simply who you choose as your capital markets advisor. Thank you for your time.